Everyone grumbles about taxes. The annual ritual of filing returns feels like a punch to the wallet, especially when the paycheck shrinks under the weight of income tax. Yet, some of the wealthiest people, like Warren Buffett, seem to glide through the system, paying less than their secretaries. Buffett, one of the richest men alive, once admitted he pays a lower tax rate than his office assistant. How does this happen? The answer lies in a complex web of legal strategies and systemic loopholes that allow the ultra-rich to minimize their tax bills. The rich do not just stumble into these savings, they use calculated methods to keep their wealth intact. This video dives into the mechanics of how the wealthy avoid taxes, exploring both the illegal schemes that land some in trouble and the legal tactics that keep others comfortably within the law. The story begins with the stark differences in how money is made in tax. Warren Buffett runs Berkshire Hathaway, a holding company that owns businesses like Geico, Dairy Queen, and a major railroad, alongside massive stock investments in companies like Apple and Coca-Cola. When Buffett took over Berkshire Hathaway in 1965, a single share cost $19. Today, that share is worth nearly $500,000. Buffett holds almost 240,000 shares, forming the backbone of his fortune. Yet, despite this wealth, he pays a lower tax rate than his secretary, who faces income taxes at nearly double his rate. The reason is simple but striking. Ordinary workers pay income taxes on salaries, ranging from 10 to 37%. The rich, however, often earn through investments, taxed as capital gains at a maximum of 20%. This gap in tax rates creates a system where wealth grows faster for those at the top. Over the last 40 years, the after-tax income of the richest Americans has surged by over 400%, while middle-class income has crept up by only 50%. The system seems rigged, but how exactly does it work? Some wealthy individuals cross legal lines to dodge taxes, engaging in tax evasion. Tax evasion involves deliberately lying to the government about income or hiding assets to avoid taxes. This is illegal and carries severe consequences. Consider a real estate deal. If Bob buys a house from John for $700,000, a 10% tax would mean $70,000 owed. To cut costs, they might agree to report the sale as $500,000, paying only $50,000 in taxes and saving $20,000. This underreporting of income is a classic trick, but it is fraud. Another method is hiding assets in tax havens. Switzerland, once a notorious tax haven, offered secrecy that allowed people like Tom, an American, to stash money in Swiss bank accounts. By not reporting this income to the Internal Revenue Service, Tom could evade taxes. However, international pressure has cracked down on such practices, forcing Swiss banks to share account details with the Internal Revenue Service. Today, hiding money this way risks arrest. False deductions are another evasion tactic. Sarah, who owns a pizza restaurant earning $100,000, might claim $30,000 in renovations to lower her taxable income to $70,000, paying only $14,000 in taxes at a 20% rate. If she only spent $3,000 but lied about the full amount, she pockets an extra $27,000. These illegal moves, underreporting, hiding assets, false deductions, can lead to fines or jail time. While tax evasion breaks the law, tax avoidance uses legal strategies to minimize taxes. The wealthy exploit these loopholes to keep more of their money, and it is all perfectly legal. One method is setting up controlled foreign corporations in tax havens. Apple, the tech giant behind the iPhone, saved $44 billion in taxes from 2009 to 2012 by using shell companies like Apple Corporation Euro in Ireland. Ireland's tax laws base residency on where a company's management is controlled, while the United States looks at where the company is incorporated. Apple set up its Irish company with management controlled in the United States, avoiding taxes in both countries. This clever maneuver let Apple dodge billions in taxes without breaking any laws. Another tactic is transfer pricing. John, who runs Wee Wee Shoes Corporation in the United States, earns $1 million from a new shoe model. At a 35% corporate tax rate, he would owe $350,000. Instead, he sets up a subsidiary in the Cayman Islands, a tax haven with 0% corporate tax. By transferring his company's patents to this subsidiary, he claims the United States branch paid $800,000 to use the brand, leaving only $200,000 taxable in the United States. This reduces his tax bill to $70,000, saving $280,000. The catch? He cannot bring the money back to the United States without paying taxes, so he might reinvest it abroad or wait for a lower tax rate, like the 21% rate introduced in 2018. The tax code favors investment income over salaries. Warren Buffett's wealth comes largely from dividends and long-term capital gains, taxed at just 15% for a $100,000 gain, compared to 22 to 24% for a salary of the same amount. This lower rate allows the wealthy to accumulate more wealth over time. Morris, a retired Wall Street investor, lives off his investments in companies like Berkshire Hathaway, Amazon, and Apple. When he sold stock for $400,000, he paid around $50,000 in taxes, far less than someone earning that amount through a job. Most of his wealth, tied up in unsold stocks, remains untaxed until he sells. This unrealized wealth is a key reason billionaires like Jeff Bezos, whose fortune stems from Amazon stock, pay minimal taxes. Bezos, often the richest man in America, can hold his stock indefinitely, avoiding taxes until he sells. Some billionaires, like Elon Musk, take it further by borrowing against their stock. These loans provide spendable cash without triggering a sale, meaning no taxes. This strategy, known as buy, borrow, die, lets the wealthy live off their wealth while deferring taxes indefinitely. Another powerful tool is the stepped-up basis loophole. If Warren Buffett sells his Berkshire Hathaway stock, he pays capital gains taxes on the profit, the sale price minus the original cost. But if he holds the stock until death, his heirs inherit it at its current market value. When they sell, they only pay taxes on gains after inheritance, erasing taxes on decades of growth. For example, if Buffett bought stock for $10 that is now worth $500,000, selling it would trigger taxes on nearly the full amount. If he dies and his heirs sell at $500,000, they owe nothing if the stock's value stays flat. This loophole lets wealthy families pass on massive gains tax-free. President Biden has proposed closing this loophole and raising the capital gains tax rate to 39.6% for those earning over $1 million annually. Estimates suggest this could generate $200 billion to $400 billion in revenue over 10 years. Critics argue it might discourage investment or prompt the wealthy to sell less stock, but supporters see it as a step toward fairness. The bigger picture. The tax system's structure fuels inequality. Most Americans rely on salaries, taxed immediately at higher rates. The wealthy, earning through investments, benefit from lower rates and untaxed unrealized gains. Morris, the retired investor, advocates for taxing the rich more, arguing a strong middle class drives economic health. Most taxable capital gains flow to the top 1%, amplifying the wealth gap. Proposals like wealth taxes or taxing unrealized stock gains aim to address this, but they face resistance. Changing capital gains taxes could be a simpler start, aligning rates closer to income taxes. Tax avoidance, while legal, exploits rules designed to favor wealth. Strategies like controlled foreign corporations, transfer pricing, and leveraging dividends or stepped-up basis show how the system bends for